Over the next 6 to 12 months, we believe the multifamily market is going to experience one of the most important transitions we've seen in over a decade. We believe that now is the best time to be acquiring multifamily apartment buildings. Let me explain why. The past 2 years have been a period of adjustment for multifamily real estate. After the unprecedented rental growth and transaction volume of 2021 and 2022, the industry entered a necessary correction. Interest rate hikes led to cap rate expansion, deal volume slowed, and many operators who are in the space today were forced to sell their properties at a complete loss. However, the fundamentals of multifamily investing are still strong. Across our target markets, occupancy levels are stable and rent growth has flattened but not reversed. So what we're looking at right now is not a collapse of multifamily in any way. It's a recalibration that will create a lot of opportunity for investors going forward. As many of you know, the Federal Reserve has recently started to cut interest rates, and they're expected to continue doing so through Q4 of 2025 and into early 2026. As rates come down, the cost of debt improves, and the values of large apartment buildings will start to rise. That's why we believe we're in a unique 6 to 12 month window where we can acquire these high quality assets at discounted pricing at what we think is truly the bottom of the market. Once that capital cost curve begins to flatten, we'll start to see investor confidence and transaction activity accelerate. Lenders are already beginning to re-engage. We see this as the early stage of a gradual recovery, not a spike, but a steady normalization that will benefit investors. On the supply side, many Sunbelt markets, including Phoenix and Dallas, have experienced record levels of new deliveries over the past year. This temporary oversupply has placed short-term pressure on rental growth and increased concessions in some Class A assets. However, new construction starts have fallen sharply by more than 40% as developers face higher financing costs and limited construction lending. That means by late 2025 and into 2026, the new supply pipeline will significantly contract. At the same time, population and job growth in these key metros will continue to support consistent housing demand. This combination of slowing supply and steady demand will restore pricing power to operators and strengthen fundamentals across the board. For investors, this environment represents one of the most compelling entry points we've seen in years. We can buy discounted properties now, execute on our business plan, and get great returns. Moving forward, Rise48 will be ramping up our acquisitions to capitalize on this opportunity. We will continue to target well-located, value-add assets in high-growth markets with strong in-place cash flow and operational upside. For investors, this is a period to stay active and to partner with sponsors who have experience, capital structure, and operational infrastructure to execute effectively. At Rise48 Equity, our mission remains clear: protect investor capital, identify value-driven opportunities, and deliver consistent, risk-adjusted returns through disciplined execution. We believe the next year will be defined by opportunity, and we're prepared to seize it.